I'm not looking forward to that, but I'll do it. All right. Well, I have my man Brian. He is a wealth of knowledge. He's gonna share. He's gonna go on about 8 to 10 minutes. He's gonna tell us what is going on in the economy, what he's seen in the market, interest rates. Brian, are you there? Take it away, sir.
Thank you, sir. Brian Maddox with Bello Mortgage, powered by Coast to Coast Mortgage. I lend pretty nationally. And what I'm going to do for you guys is a quick market update. We're going to talk about where rates are, where they're going. We're going to talk about big picture housing markets and then some headlines that affect real estate investors. And if you see me on other places, sometimes you might see a slightly recycled information, but this should be pretty fresh. So we're going to start off with jobs. See if I can. Oh,
I
Billy,
made you a presenter, Brian. That way you
yeah,
can
can
share
you
your
stop?
screen. Let me know if that went through.
Yeah, can you stop sharing?
Yes, I can.
It's telling me I can't share what you share.
Bear with me while I figure this out. Okay, if you want to talk through it.
Okay. So yeah, we're going to start with jobs. If you go to the doctor, they're going to test your blood pressure. That's a leading indicator, right? If you've got problems, sometimes they can detect that in your blood pressure. And so we're going to look at jobs for the same reason. We're going to look at, let's see if this is right now. Not yet.
Not yet? We'll get it.
Oh, there we go.
Okay.
Okay, we are good to go.
All
So if
right.
you ever want to know anything about the market or any questions that are financial, you can type in your question and then follow it by Fred. Fred is the St. Louis Federal Reserve's website, and it controls where it hosts tons of data. So we're looking at jobs because this is going to be a leading indicator of what is happening in the environment. As borrowers, this sounds weird. I don't mean your family or your friends, but when we're borrowing, we want unemployment to go up. That is going to help mortgage rates out. So I'm not wishing death and destruction on the economy, but a little unemployment ain't so bad if you're borrowing money. So we're looking at we're going to, over the time, we're going to continue to look at initial jobless claims. So these are people that just filed for unemployment. And we are not actually looking horrible if you look past this last year. We only had 198,000 new people filing for unemployment. So that is not so bad. And then we want to look at continued claims. So this is people that are receiving unemployment. And this is a little bit of a liar report because most areas you can only receive unemployment for about 6 months. Some states a little longer, some states a little shorter. So some people do fall off of the continued claims or the continued unemployment. And this has been really high. You can see that we started off the year a little bit lower and we built up through the summer months. And right now it's down a little bit. And again, that could be a little bit misleading because we're kind of past the government layoffs. Oh, sorry. Oh, I thought I heard somebody talking. When we zoom out, we're going to see COVID up here. And then you can see 2022 was really low unemployment. We were in the 1.3 million, 1.4 million. And we're sitting right now almost at 2 million unemployed. It's like 1.8, 1.9 million. Most of this last year, we sat in that 1.9 million range. So when we look at unemployment, this last year, 2025, we only added about 48,000 jobs per month on average. And that is not great from post-COVID. And then it's also not great if you look pre-COVID. So this is just a very bad trend that the jobs market is softening. And that is what might lead the Fed to make some moves. So when we look at the Fed, they have two tasks. One is keep inflation low, and the other is to keep unemployment low. And they pick which of their tasks is the most important. And right now, when the Fed is lowering interest rates, they're saying unemployment is a bigger concern than inflation. But we're in a weird spot because inflation had been kind of going up throughout the year. And this last part of the year, we saw inflation tick up, partly because of tariffs, partly because, well, we've got people spending money, and that is not good for mortgage rates. Inflation is going to rise mortgage rates, unemployment will lower it. So we have our next Fed meeting on January 28th, and right now there's a 95% chance that we are not going to see a rate cut. When we look further in the year, March, there's still an 80% chance that we do not cut rates. And then April, we've got a 67% chance to cut rates. So the farther out in the year we go, the more likely we are to see a Fed rate cut. And Fed rate cuts, the last 3 or 4 Fed rate cuts, we actually saw mortgage rates tick up a tiny bit right after the cut, but we saw rates improve about a week or 2 weeks prior to the rate cut. So we do want to pay attention to the Fed and what's happening. They don't directly affect mortgage rates, but that market data is what helps drive investors who are buying mortgage bonds. All right, today's mortgage rates, we're sitting at 6.4% on average nationwide for a conventional loan. FHA is looking pretty at 5.7. There is about a half a point benefit to a 15-year on owner-occupied deals. For investors, 15-year mortgages oftentimes are the same rates or could even be a little higher than the 30-year rate. So we don't do investor mortgages at 15 years very often. When we look at the markets, we're going to look at the 10-year Treasury. This is the easiest thing for you to watch. If the 10-year Treasury is going down, mortgage rates are probably getting better. And you can just Google US 10Y. We're sitting right now at 4.16. And on this chart, up means more expensive rates. We want to see this chart declining. So if we look back throughout the year, things were getting a little bit higher as the end of the year rounded out, but we ultimately ended the year lower than we started the year last year. And we started this year about 1% lower than last year. Rates were about 1% higher last year in the 7s. And right now we're in the low 6s. The mortgage-backed securities, this is the actual bond that trades on Wall Street. And on this chart, down means more expensive, up means cheaper. So we want to see this rising. So this is a better trend for the end of the month. Rates were slowly getting better over time as we finished out the year, which is good news. When we look at the 10-year Treasury, historically, we see about a 2% or 1.75% spread. So if you're looking at that 10-year Treasury, it's 4.17. Mortgage rates right now are 6.04. So we've improved a tiny bit since December. We've come just under that 2% spread. So if you look at the 10-year Treasury, you're at 2%. That's about where mortgage rates are for owner-occupied clients. And then investors, we usually pay about a 0.5 to 1% higher rate. I did a quick analysis on a $300,000 valued house doing a 75% cash out refinance. And I used a 740 credit score. This was live tonight. So we could do a 6.84% rate with a 5-year prepayment penalty if we do a cash out refinance up to 75% of the value of your home. If you pay 2 points, you're getting a 6.24% rate. That is not bad for an investor, especially when owner-occupied rates are at 6.04. So we can get investor rates by paying a couple points just over owner-occupied rates. Where are rates going? When we look at the projections from Fannie Mae, they think rates are going to stay right around the 6% mark all year and next year. The Mortgage Bankers Association actually thinks rates are going to tick up a little bit this year and then maybe kind of stay in that low to mid 6% range. And when we look across the different bodies that help predict rates, Redfin, Fannie Mae, Mortgage Bankers, low 6% range is predicted. So we're not predicting a great improvement to rates this year unless unemployment ticks up. One thing that's going to affect rates is Trump did just direct Fannie Mae and Freddie Mac to buy $200 billion in mortgage-backed securities. That should help push mortgage rates down. The day that announcement came up, we saw mortgage applications rise 28% just based on that news. So I'm going to fly through a couple slides real quick just to give you a kind of a market outlook on housing. And I probably won't get to all my slides because I went a little long in the beginning to help set up how we're going to do this. But this is showing a chart of active inventory from December 2019, so right before COVID until the end of last year. We have 17 markets that have more inventory right now than we did pre-COVID. Texas, you're sitting up in the 34%. It's one of the highest. I'm in North Carolina. We just switched. We were underneath that average for a little while. And then you've got a couple other markets that are sitting kind of high. If we look a 1-year look back, so over the last 12 months, this is active inventory between December 24 and the end of last month, Texas actually kind of recovered a little bit. They're only 13% higher inventory. Florida really recovered. It was hurting a year ago when we looked at this chart. North Carolina is really leading the pack here. And then a little bit up here in the mid northeast area is kind of got a little bit more inventory than what we've seen. What we see in inventory as we're in January is we usually see inventory tick up, and throughout the summer, we see it cap for the number of active listings into July. So it is very normal right now for us to see inventory increase as we go into our very hot summer and spring season. And then in the winter is when we really see a drop off, and that's very consistent. Last year was very consistent with prior years to COVID, a little better than COVID, but prior to COVID, not quite as hot as post-COVID. And then the last thing I wanted to show you is what may come when we look at house values. So this is the 7 indications: Zillow, Case-Shiller, Freddie Mac, Cotality, ICE, and FHFA. They're all predicting mild improvements to house prices over the next 12 months, between, basically staying flat to maybe a 1.8% increase in house values year over year. This has got 26 or 27 different predictors. And there's a couple of boneheads that don't like this housing market, like the National Association of Home Builders. They think house values could go down this year. I really hope they're wrong. The Mortgage Bankers Association thinks it's going to be fairly flat. And then, majority of people think we're going to see, a 1 to 2% increase in house values. So my name is Brian Maddox. There's a quick QR code for my contact information. I am leaving tomorrow to go to Denver to watch my Broncos play the Bills. So don't expect to hear from me tomorrow through Monday. I'll be traveling, but next week I'll be back at it. Thank you so much for the invite, and reach out if you've got any questions.
Thank you, Brian.